So I was looking at Nvidia's earnings as we always do every quarter because they're just fascinating, and they were fascinating again, Steve. So definite signs of revenue slowing now, Steve. We've seen those quarters where it was growing at hundreds of percent, and obviously you can't keep that up forever. So revenue for this quarter was 44.1 billion, up 69%. Net income 18.8 billion, up 26%. That's about a 43% margin, though, so very, very good for net income. Operating cash flow, just 27.4 billion, only up 79%, margin 62%, and about 26.1 billion of free cash flow, up 75%, a 59% margin. Terrible, Steve. If you want to segment it, compute was up 75% to 39.6 billion, and graphics was up to 4.5 billion, up about 33%. Data center 39.1 billion, up 73. Now break that down into compute and networking. 34.2 billion of it was compute, 76% growth. 5 billion networking, up 56%. Gaming 3.8 billion, up 42%. So that's very impressive. That was something that had been lagging. People had forgotten that Nvidia was primarily a gaming company only a few years ago, and that's not the case anymore. Pro visualization, 509 million, up 19%. Automotive, 567 million, up 72%. And OEM and other was 111 million, only up 42%. This guide, Steve, would have been higher. So it would have been about 53 billion, which would have been another huge stack of incredible growth. But unfortunately, the US has export banned the H20s to China. So you've got to knock 8 billion off that, but it's still going to be 45 billion in revenue, which is representing incredible growth again. Gross profit margin, they said, would be between 72%, heading towards 75%. So that's what they give you for the guide. It's up to you to fart around with the numbers to get them to where you want them to be. Call, Steve. Very strong quarter. Revenue 69% up year over year. Exceeded expectations in what they said was challenging environments. Data center revenue was very robust. And again, this was driven by AI factory build-outs and this strong shift to inference workloads, which obviously Nvidia is there to slap up. The US export controls on the H20, which was essentially a GPU that they made specifically for China, was obviously export controlled, and that significantly impacted Nvidia. Recognized about a 4.5 billion charge in Q1, unable to ship about 2.5 billion in H20 revenue. They said that essentially the Hopper business in China for them in the data center has ended. There's not really much they can do about it, and obviously you should anticipate a meaningful decrease in China data center revenue in Q2. They said that the AI market in China is about $50 billion, and they think that market is completely closed to the US industry now. And look, they're exploring other options. They think this export ban is quite wide-ranging, and it's going to hurt the business. Not just that, strengthen foreign competitors. And they said that their argument is that China's AI is going to advance regardless, and that restricting US chips is just going to boost Chinese innovation, which is exactly what people like ASML have told you will happen. And I guess what we saw with DeepSeek when that came out. Onto some more positive things. They said the new Blackwell platform was ramping up incredibly fast. It's now contributing about 70% of data center revenue. The hyperscalers are rapidly deploying these Blackwell systems, and software optimizations are continually improving their performance. They've actually got a new Blackwell Ultra GB300 fax machine that has begun sampling. Demand for the AI inference is surging, like we said earlier. Microsoft is seeing exponential growth in token generation. Nvidia sort of highlights this acceleration to this massive build out of AI factory deployments. They said that there's 100 Nvidia powered AI factories in build progress this quarter. which is pretty incredible, I thought. So yeah, they said that they're committed to this annual product cadence, which simply means it's kind of a product refresh. Every year there's going to be something new coming out. They're investing heavily in expanding its own infrastructure and AI solutions. They were keen to point out that they've returned about 14.3 billion to shareholders just in Q1, and to also point out the key drivers of their future growth is demand for reasoning AI, the rescinding of the AI diffusion rule, the rise of enterprise AI, and this continued widespread build out of these AI factories. They said that they're actively involved in reshoring advanced manufacturing in the US, and this is through happening through TSMC essentially and other firms that they use. And they're also really keen to point out just how strong sovereign AI has been as well, and sovereign AI initiatives, which is, we've discussed this before, but it's essentially where countries build their own AI infrastructure. And they're saying that continues to be a significant growth engine for Nvidia globally. It's another one of those reports, isn't it, Steve? It's very hard to find anything in here that is particularly bad. Now, I have ran a reverse DCF on this, as I normally do, and I work out that I did about 0.2% buybacks every year, because I don't think they're going to get much higher than that as the share price continues to ramp up. I did a terminal growth rate of about 2.5%, discount rate of 10%, and I work out that there's about 19% annual growth built into this company, and it's obviously going to have to do that over the next 10 years for that to make sense. Now, you can think to yourself, well, that's fine, that's all doable. But in the terminal year, Steve, they've got to essentially have $500 billion or getting on for $500 billion of free cash flow. And I mean, I'm not saying based on these results that that's not possible, but I find it increasingly unlikely. And I would say that with the hesitation of I have no position, no dog in this fight whatsoever. I just don't think anybody's ever hit those kind of numbers, and I'm not entirely sure anybody can hit those kind of numbers, Steve. But like I said, 10 years is a long time, and we have a sort of tendency and a bias to sort of underestimate what can be achieved in a decade. But it seems like a high number for me, Steve. $500 billion in free cash flow. Is it something you think is feasible? I mean, I didn't think what Nvidia are currently doing is feasible. But yeah, what do you think?
Yeah, here's the thing with Nvidia. There aren't many companies that I would back to do 19% a year every year for 10 years. And I actually wouldn't back Nvidia to do it either. But the thing is, and if we wind this back and just think back over the last sort of 3 years or so, they're taking massive bites out of it at a time. So if they do 60% for 3 years in a row, which they might, they won't have that much to go to get them to sort of 19% per year for 10 years. They can then kind of creep along at what I consider a much more normal rate. So it's interesting. When I think about this as 19% a year for 10 years, it seems like a lot, because 10 years seems to me like a long time to be doing that level of growth. When I think about it as maybe 5 years of 30% or something, and then something coming down a lot more from there, it sounds a lot more plausible to me somehow, which is the level of analysis that I have of this thing. In all honesty, I got kind of interested in Nvidia when it was down at around $90, and the forward PE number was looking, well, it began with a 1, and I thought to myself, oh, is it worth a stab here? And I settled on the idea that the answer was no, because generally speaking, when I ask myself, is it worth a stab, I tend to think you don't know what you're doing here well enough, or anything like well enough. Just stop it, basically, and look the other way, and it will probably run off into the distance. But I'm okay with the idea that I gave it some thought and thought that it wasn't a goer. I was impressed by this. The thing that impressed me the most was twofold. One was Blackwell going mad, and demand for the hyperscalers they all seem to be terrified to not spend all their money, and the hyperscalers, as we've reported on, just keep making more money. And if that's where they want to spend it all, then, well, Nvidia has a pretty robust customer base there at the moment, whether it's Google or Amazon or Microsoft or whoever. But the thing I was most impressed by was how well the company has handled this really annoying China situation. They have a properly moving target around this. If they're not allowed to export their kind of best chips to China, so they came up with a different one and said, okay, we'll export this instead. And then the US said, no, you can't export that either. And it's really annoying because now they've got piles of chips that they would like to export but can't. And it doesn't seem to have massively slowed down. It's annoying, and it has weighed on things. As you mentioned, that guide would have been about 8 billion higher, but for this. But it's really impressive the way this company is working around what I would consider to be issues that I would genuinely understand a different company saying, this is a huge and massive problem for us, and our revenue growth is now going to be we're going to go negative on revenues because it turns out they've just changed the sodding rules that we were set up to deal with. And Nvidia isn't doing that. It isn't doing anything of the sort. It's growing at a rapid rate, a slightly less rapid rate because it's a legitimate annoyance. But I am impressed at how well they are hanging in here. Steve, I thought this was, a very impressive result. I sort of feel like I felt for ages, though, but increasingly it's weird. The more I get, the bigger these numbers get, which is the opposite way round to how it should be, the more I get worn down with my thinking, but these numbers are too big and they can't keep growing at this rate. And that's exactly the opposite. We're getting closer and closer to the point where they can't. I don't know where that is, but we're not further from it at whatever numbers we're at now than the numbers we were at a year ago, 2 years ago. We've got to be closer by pretty much definition. Trouble is, can't tell you how far that is.
Yeah, well, just to sort of finish that point off, I guess, is that you have to sort of believe that Nvidia, to be able to generate that level of free cash flow, is going to get to about 700 billion in revenue annually in 10 years' time. And that to me feels further away, Steve, than the free cash flow number somehow, because that revenue, where is it going to come from? Because I think what we have seen really is the people who are really spending the money on this, the data center boys, the Microsoft, the Amazon, the Google, that's a large portion of their current revenue if we added them all together to get to that Nvidia revenue. So what we have to kind of be saying is, the next 10 years, whatever Google, Microsoft, and Amazon grow to, is going to be their own. All other revenue kind of has to work its way to Nvidia. And I'm not 100% on board with that, but remain a cheerleader from the side, Steve, who absolutely loves reading these reports and wishes everybody in the stock well.
Sovereign AI is, I suppose, meant to fill a good amount of that gap and perhaps take some of the pressure off the very ambitious assumptions about hyperscaler revenue that floods its way basically across to Nvidia. Whether or not sovereign AI feels like it's in quite the same arms race as the likes of Amazon do is another question. So I think with Amazon, I can see they don't want to get left behind on this as best they can. And it really matters to them competitively. Does it matter as much to Singapore, or is this kind of something that Singapore could back away from without similar kind of challenge? Maybe is my thought on this. And I feel as though sovereign AI revenue might be less reliable than hyperscaler revenue for the moment. Not because I think sovereign AI is more likely to run out of money. I think the opposite, actually. But, actually pretty close. But maybe the other way if I was really forced. I wonder whether they might find themselves just having different priorities in the future because they have different things to think about there. But also cheerleading from the sideline, very, very close to setting foot in the arena myself. But to be honest, even if I had, I'd have sold it by now. So that's part of the reason I didn't, to be honest. I was thinking, this isn't really proper investing for me. I'm going to take it now. And if I see this thing is up 25%, I'm going to sell it and think it's great and then watch it go off another 250. But such is the way of investing. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.